Hello, today I'm going to be doing a stock value analysis, and I'm going to be implementing using the driver framework to do this analysis. And so first, just to kind of set the stage for what analysis we're going to be doing. So we're pretending that we've inherited $75,000 from our aunt who always said to invest in quality companies. So we're considering Microsoft stock, which is currently trading at $380 per share. So some more key information here, just to kind of set the stage. Microsoft pays an annual dividend of $3 per share. Dividends have grown at 10% annually for the past 5 years, and analysts expect 4% growth going forward. The S&P 500 has returned 10% annual on average. Treasury bonds currently yield 4.5%, and then finally, a another alternative option that we have is to put the money in a savings account at 4% annual interest. So some questions we want to answer by the end of this. We're going to come back to this as a little recap at the end, but just some questions based off of Microsoft and the dividends. And if we would buy it at 380, what return can we expect? Is it a good buying price? And then kind of a conclusion at the end. So first, for a driver framework is to define and discover. So we want to kind of start by asking what makes a stock valuable. So the stock is valuable because Microsoft has a strong brand, market leadership, consistent cash flow, and a diversified business model. And Microsoft has a lot of growth potential. Investors expect them to grow its earnings and dividends over time. Then finally, they have competitive advantages through intellectual property and scale. What are investors really buying? They're actually buying a claim on the company's future economic value. They are buying a share in future cash flows through dividends, capital gains, ownership, and voting rights. And then finally, investors are really buying growth potential. They're betting on Microsoft's ability to innovate and sustain competitive advantages. Next, we're going to represent. So before we do our calculations and dive into those, we are going to map out the expected cash flows, which I'm going to outline in a table on the next slide. But first, just to kind of share how we solve this. So we first figure out how many shares we can purchase. So we have $75,000 of inheritance, and the stock price is $380 per share, which means that we can purchase 197 shares. So then to project the dividend we'd receive for one share of each of the next 5 years, the current is $3, and then we knew from the previous information that it grows by 4% each year. And then finally, we can multiply 197, which is our shares, times the projected dividend per share for each year to calculate the total annual cash flow. So here's a nice outline of this for the next 5 years. So it shows the current year, the dividend per share, and the total annual dividend for the 197 shares. And this is based off of, like we talked about before, the 4% per year. Now we're going to implement. So to implement this, we're going to build a valuation model and explain our assumptions and logic. So we're going to actually head over to a different tab here, and we are going to look at our Gemini and then at our collab notebook. So here is for Gemini. When we asked it the information, it gave us our code here, and then we copied it and put it in our collab notebook. And so here we have our collab information. We're just going to kind of break this down piece by piece, and hopefully it'll help us make some sense of, excuse me. Oh, excuse me. Hopefully it'll help us make some sense of this code and what Python gave us here. So first, to define the inputs from the scenario. So just kind of outline some of the numbers here that we talked about towards the beginning. So the current price is 380, current dividend is 3, growth rate is 0.04 because it's 4%, required return is 0.10 because it's the 10%. And then number 2, after we define the inputs, calculate the intrinsic value, and we're going to be using the dividend discount model, or DDM, which is really important to remember throughout this whole analysis, is that this is the model that we're going to be using to answer these questions. To solve the analysis is the dividend discount model. So we're going to calculate the intrinsic value using this model, and then we know the formula there is D1 divided by K minus G. And then we can calculate the DDM value, ensuring required return is greater than growth rate. And then our third step is to calculate the expected return if we buy at the current price. So is trying to figure out there with that formula here, the dividend yield equals next year's dividend divided by current price, and the expected return equals dividend yield plus growth rate. So trying to figure out if we do buy at the current price, what is our expected return? And then step 4 is want to perform a simple sensitivity analysis on the growth rate. And then here are questions, which we're actually going to dive into more later rather than doing it right now with this Python code. But just as a brief outline of these questions that we are trying to answer in the end, which we'll recap later. So we put this all into our Colab notebook, and then we ran the code in Colab, and it gave us this analysis here. It gave us the the code after it was ran. So first, the DDM valuation. So we figured out that the intrinsic value of Microsoft is estimated to be $52 per share. And secondly, the sensitivity growth rate. We're going to explain all of these things a little bit more later when we dive into a recap of the questions, but this is just what our code showed us in Colab here, the Python code. So the sensitivity to the growth rate, we learned that the valuation is highly sensitive to the growth rate assumption, and we did this by testing different percentages. So at 3% growth, the value would be about $44. At 4% growth, the value would be about $52, 5% about $63. So you can really tell that even just 1% difference in growth gives us a very different value. The number 3, we figured out, the expected return at a $380 price, and we figured out that our total expected return would be 4.82%. And this, a little why behind this, it's composed of the 0.82% dividend yield and the 4% growth, which we kind of saw in the projected cash flows earlier. When we were going through the driver framework, we saw that it grows by an extra 4% every year. And then finally, the final recommendation, which we're going to talk about more later as well. The verdict is that at $380, the stock appears to be overvalued based on this model. Once again, keep in mind that we're using the DDM model, which we'll realize later might not be the best model for this analysis, but based on this model and what we know, the stock appears to be overvalued. And this is because the DDM value of 52 is so much less than the market price, which is $380. And then the action, what should we do from there? We should be cautious. Investing the full $75,000 might not be advisable. We will consider investing partial amount or exploring other investments. So here was our Python code. We put it into Colab and we solved it, and this is what we got. So now we are going to go back to this PowerPoint here to finish up our driver framework. So we built valuation models and explained our assumptions and logic of that code. So now to validate, we want to compare our valuation with the current market price. We want to explore the differences. So as we touched on a little bit already, the DDM valuation is $52 per share, but the current market price is actually $380 per share, which is a major gap from $52 to $380. So why is there this major gap? As we already talked about a little bit, the DDM, this model, has a lot of limitations because it's based exclusively on the present value of future dividends. The market value, on the other hand, is based on the total expected value of the company. So there's this big gap in the differences between what the DDM did and solved and got versus with the current market price that takes a lot of other things into consideration. The DDM ignores reinvested earnings, share buybacks, non-dividend factors such as market position, brand value, and future opportunities. So when we try to validate here, we actually realize that there's a big gap in difference with our valuation and the current market price. And that's a big reason why this V or validate step is really crucially important in the driver framework. Because in this case, we can see that when we tried to validate, we realized that there was this really big gap between our DDM valuation and the current market price, which told us that we want to be careful and not only look at the DDM valuation that we did. Next, we're going to evolve. So how would different growth assumptions change your valuation? So as we saw before, talked about a little bit, it is very sensitive And so different growth assumptions would dramatically change the valuation. The constant growth rate is the most sensitive and influential variable in the DDM, so small adjustments can lead to vastly different results. So on the left-hand side here, we can see the assumed dividend growth rate. 4% is our original, and we just tested a few other numbers here, 2, 6, 8, and 9.5%. And then you can see how drastically different the value per share is based on the assumed dividend growth rate. So our original was $52 per share, and then if we rose it just even by 2%, it was a 53% change from our original 4%, and the value per share ended up being 79.5. So you can see here that the constant growth rate, the assumed dividend growth rate, is really, really sensitive. And as you change this even just a little bit, the calculated value per share changes drastically. And then our final step for our driver framework is to reflect. So what does the gap between our valuation and market price tell us? It tells us a lot. It tells us that the market's assessment of Microsoft's value is based on factors that the dividend discount model does not and cannot capture. It's an insufficient model to capture all of these things that the market price tells us. The market is pricing in total growth, not just dividend growth. The assumptions of this model are just simply too simplistic. So this gap actually quantifies the intangible value, such as Microsoft's dominant market position, powerful brand equity, and intellectual property. So basically, the market price also takes those things into account. Whereas the DDM is even though it's a really helpful model, it's also too simplistic and it has a lot of limitations because it does not take those intangible things in account, such as Microsoft's market position, brand, or intellectual property. It only focuses on dividend growth. And then finally here, we are going to talk just a little bit of a recap. As promised, we're going to revisit these questions we asked in the beginning. So Microsoft, when we use the dividend discount model, the DDM model that we've been using throughout the entirety of this time, Microsoft is worth $52 per share. How sensitive is this valuation to growth assumptions? It's extremely sensitive, which we saw in that table a few slides ago. When we change it just slightly, the dividend price changes a lot per share. And then if we buy at $380, what return can we expect? Our expected annual return would be 4.82%. So is the $380 a good buying price? Overall, the answer would be no. The calculated value of $52 is significantly lower than the market price, which is the $380. And then the expected return of 4.82 is well below our required return of 10%, which the information in the beginning shared with us that the required return or the average return or whatever that specific was 10%. And the expected return of this is only 4.82%, which is very low, very much lower than the 10%. So finally, should we invest the full $75,000 partial amount or look elsewhere? So as you remember in the beginning, we received this $75,000 from our great aunt who said to make sure to invest wisely. So what are we going to do? We are most likely going to look elsewhere. As we found using the DDM model here, there's a big gap between the $52 and $380, and also the big difference in return. We would really like a higher return than 4.82%. We'd like something closer to that 10%. So we could consider still investing a little bit into Microsoft, but all in all, we would really like to look elsewhere to invest the money somewhere else. Thank you.